Welcome, Washington, D.C. Metro, to Ryan Sloper's Real Estate Radio, the most important hour of radio every Monday on 1580 AM, The Big Talker. Thank you for joining me this afternoon. For those of you who don't know, Real Estate Radio is a show dedicated to building the Washington, D.C. Metro's housing and credit markets. Within every market, there are solutions, as well as tremendous opportunities. You just need some trusted advice. That's my message, and I will be delivering it to you guys every Monday from 2 to 3 p.m. right here on 1580 AM. We've got some great stuff lined up today. A lot of topics going on in the media right now, all the way from, the tornadoes that just hit down in Missouri, killed another 91 people. Just seems like week after week it's one storm or the next that's, taking countless lives. It's very sad, and, I'm just hoping that we can have these tornadoes and other tropical storms start to tail off throughout the rest of this year. Joining me on our panel first today is Louis Cammarosano, who's the general manager of HomeGain. You can check out HomeGain at homegain.com. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Reuters, Smart Money, MSN, and many others. Louis, it's great to have you on again today.
Hi, Ryan. How are you?
I'm doing well. How was your weekend, Louis?
It was all right. Yourself?
It was pretty good. I don't think I did anything too exciting. I actually went to a WMZ Q-Fest country concert, but that was pretty much the highlight of my weekend.
What'd you do with the little one?
The little one stayed at my dad's house anyway, so he kind of hung out there all night. So it was kind of it was good. My wife and I got to get out for really one of the first times, and a much needed rest that night.
Happy to hear that.
Yeah. So you do anything interesting? I know you told me you had some baseball playoffs for your kid.
Yeah, they were in the playoffs. They had the best record this year, and they won one, lost one, but they had the best record of the year, so I was pretty proud of them.
Didn't you say you're coaching too?
Yeah, I was coaching the team, yeah.
Oh, so congratulations to you as well.
Oh, thank you.
Well, we got a lot of stuff going on this week, Louis, and tailing from the end of last week where Greece, there's a lot of reports, and this is in the Eurozone over there, that the dollar and just basically I believe it was Fitch downgraded Greece's bonds to, what was it? Let's see, highly speculative, putting it in the junk bond territory.
And they also put Belgium into the negative. So that's definitely not a good sign. But it is giving more strength to the dollar, because I've just checked this morning. It looks like the dollar is pushing higher. And for a lot of people out there that are trying to figure out how this relates back to them, more money is basically going to be coming back into our bonds, where it's going to be looked at as more of a safe haven, which is ultimately going to drive interest rates, continue them on, lower. I did want to mention, because I think this is worth noting, and it's more of a technical fact than anything else, but the 10-year note, which is typically a very good indicator of where mortgage interest rates are going, has not hit below 3.10%. And that's actually yield that's being paid to investors, okay? And I think that the reason to note this is because for a lot of people that are on the sidelines right now and trying to figure out, if it makes sense for them to potentially refinance or buy right now, and they're thinking maybe the rates might go even lower, we haven't broken through this technical floor of support in a long, long time. And I don't think, if it doesn't happen this week, I tend to believe that we are going to start to see that bounce back upwards. I believe right now, if I'm looking at CNN Money, it looks like the yield's at 3.12. So we haven't hit this in some time. So, I want to say that if we don't break below that this week with all the stuff that's going on in the Eurozone, that we probably are going to have a technical bounce higher. So what that means for you, the consumer, is interest rates are probably going to, gradually increase maybe an eighth to a quarter over the next week or two. So that's just, one of the predictions that I'm going to go ahead and make. I mean, Ryan, I agree with you, and it seems like every time the euro gets in trouble, people rush to the dollar, and that's kind of been a knee-jerk reaction. But now you and I view that as running away from the blast and towards the tornado.
Right.
Because the United States has similar problems. You can equate the debt issues of California, Illinois, and certain municipalities with Belgium, Greece, Spain, Portugal.
Yeah, as a matter of fact, I was listening, I believe it was Squawk Box this morning, and they had one of the governors of Illinois on there, and he had said that they were basically sounding the fire alarm. I think that they had already basically mentioned that they were in deep trouble. I believe that they're behind California is in the most fiscal trouble right now. I believe they own anywhere from 40 to 50 some $50 billion. And they're basically putting everybody on notice that if they don't do something as far as cutting spending, then this is going to be really problematic down the road, just because of
if you're not producing more money than you're spending out, I mean, obviously that's just a regular business issue that most businesses run into. I mean, this is something that our federal government's running into, but now it's like all the other states are really, I think they're coming up against a brick wall here in the next 5 to 6 months.
Right. In question, Ryan, whether, like they do in Europe, whether they do bailouts of the member states, whether the United States Federal Reserve will bail out states. That would be devastating to the dollar.
Right.
Because that'd be an additional, not a stimulus, but a payout, which did nothing other than just send money to states who needed it, just to keep running.
Yeah, I totally agree with you there, and the Fed, what was it, the minutes that they released last week? Let's see, they confirmed that the Fed would not and will not consider further easing as the economy stands now. The debate from last week was mostly that from April 27th of the Fed meeting was mostly about the first potential tightening. With the technical failure of what's going on around the world and everything else, I mean, I don't think they can touch rates for the next 2 or 3 years at this pace.
They don't, Ryan, but the news flash just came in. It's on Market Watch that the results of QE2, I think they spent $600 billion and they created 700,000 jobs, and that equates to $850,000 a job. And they also calculated where housing prices were pre-QE2. The average median home was $177,300, and now it's at $163,700. So that's 8% less. So they're calling the QE2 a bust. So they may have to keep interest rates low, but can they afford to do QE3 with this negative publicity and really seeming lack of results?
Yeah, especially as we're heading into, basically the elections coming up in the next, primaries or whatever.
They kind of have to do something, even if they don't get results, just to keep the interest rates down, because it seems to be the policy that they want to prop up the housing market and the employment market.
Yeah.
And these are some results, albeit that they're expensive, although in the housing, they could probably claim that the housing prices would have gone down even more if they hadn't done stimulus.
Yeah, potentially. You're listening to Real Estate Radio. I'm your host, Ryan Sloper, joined by Louis Cammarosano, the general manager of Home Game. Another interesting point that I had heard, they have all these commissions and everything that are set up to try to basically figure out what to do with this debt ceiling and the plans that are put in place. I thought it was very interesting because they were talking about the Bush tax cuts, which are now the Bush-Obama tax cuts because they were extended by Obama. And they were kind of come up, what are the potential things that we can do to get this debt ceiling under control to curb spending? And one of the things he noticed is that the U.S. spends out $4 billion more a day than they actually bring in. Now, that number is just incredible when you think about it. $4 billion. I mean, and if you just basically went and started chopping entitlements and other things, I mean, we could get that number down pretty quickly. But he went on to say, and this is something that struck me as pretty crazy, but the top 1% of income earners, which is over $530,000, paid last year only an 18.8% tax rate. Now, the reason for that is because there's loopholes with the way that they can, calculate a lot of their income with capital gains. And that was part of the tax cuts that were the Bush tax cuts that were extended. Now, everybody knows that the highest marginal tax rate that's out there right now is 35%, but yet nobody's paying that. So you would think you have to do something as far as broadening the tax base to be tax evenly across the board, so to speak, because you can't have the most wealthy people on earth paying, 18, 19%, and you have just a regular, person over here making $125,000 that's paying about the same. Wouldn't you agree, Louis? I mean, that you can close the gap tremendously just by that.
Well, you could, and I don't dispute those numbers, but there's also a statistic. I think 40% of the American public don't pay any taxes.
Yeah, I think it's actually more than that. I think it's like 51%.
Exactly. So you're definitely right that the tax issue is skewed, but the real issue is not that the United States doesn't tax its citizens enough. It promises too much and pays too much for the services we get, and that's why we have the debt issue.
Yeah. It's crazy, but we're gonna keep our eyes on it, see where we go each week. It seems like we're kind of moving in the same direction. Another reminder.
You know what'll happen, Ryan? If you start taxing people over 530 at a certain rate, they'll just keep raising taxes on everybody, and then think the problem is solved.
Yeah, well, the other interesting thing that I took away from what I was watching this morning is that they said that one of the things that I think it was Walker's the one that said this, but he said that the thing that he sees that is the most problematic right now is the fact that there hasn't been enough like capital formations of like companies forming. You know what I mean? New companies forming, which is typically an indicator of when the economy is either moving ahead or at least turning the corner, is what you would start to see. We're not seeing enough of that.
That's because we don't have any savings, and when you have low interest rates, no one saves money, so capital can't form. And then when you have stimulus, people just throw money at the stock market, irrespective of the valuations of the companies.
Yeah, and
you get things like LinkedIn going out at $100 a share with PEs in the stratosphere.
It was actually pretty crazy. Let's talk about that for a second. I mean, what the initial IPO was around, $45, something like that?
It went up to $110.
Went up to $110. And that kind of shows you that just the general public, I think, they're just willing to jump on anything, that has to do with the social medias, just because I think that everybody, it's so prevalent between, Facebook, Twitter, LinkedIn, everybody, the way everybody communicates these days is so tied to social media. It was like what you just said. They're just willing to throw their money at anything in the stock market, and that seemed like the best and brightest thing to throw it at.
Well, if everyone's throwing at it, it goes up. It was just like the housing boom.
Yep.
Everyone was buying a house, so the prices are going up until people realized that the houses weren't worth 3 times the price that they paid for it.
Yeah, interesting to note. I would believe, let's see, this report was on May 17th from CNN Money, but the housing starts have dropped 10% in April. Housing starts, the number of new homes being built fell 10.6% in April to an annual rate of 523,000 units, down from a revised 585,000 in March. It's interesting because with the low interest rate environment, this is one of the things that I focus on a lot is, you would think that the builders are out there trying to get as many homes built as possible in a time when it's a low interest rate environment. So if you're not seeing as much of that, that kind of tells me that some of these companies might still be cash strapped, or they're not being the banks are, obviously being more stringent upon lending. But there's got to be some builders that are strong out there that have a lot of capital.
Well, you know what it is, Ryan? I think there are some that are strong. They own a lot of land. It doesn't make sense for them to build them if they're going to go into competition with all that inventory out there that's underpriced.
True. Now, we're talking nationally, but like in, the Washington, D.C. metro area, I mean, the new home sales are going through the roof right now. I mean, because there's nothing else to buy. Like, they're out there looking. My choice is I'm going to look at a foreclosure, which there's not much inventory of foreclosures. Then I'm going to go to a short sale. I don't want to wait 6 to 8 months before I find out what's going to happen. There's a few normal sales, but a lot of them have, they're old and outdated, haven't been renovated. So then you have new builds where you're going to pay a premium for the new build, but when that's all that's left, that's where people have been flocking.
Sure, but also keep in mind, outside the D.C. area, a lot of the new homes are built kind of in the suburbs and the exurbs. And with gas prices being high, people are flocking towards the houses that are closer to home, and those are the existing homes. So it's very tough being a home builder right now because you're competing not only with the existing homes on the market, but you're also competing because in most cases, home builders have land outside the center of the cities.
Yeah, we have a segment coming up at around 2:30. We're going to talk with Scott McDonald, the broker owner of RE/MAX Gateway. And actually, he had posted an article online on Facebook that kind of sparked a little debate amongst realtors and others. On the foreclosures are at the lowest level in 40 months. This is according to Realty Track. And, we're going to jump in and kind of explain what all that means and why, just because we're looking at the numbers saying the lowest in 40 months that's not going to necessarily stay the same, or if not get worse moving forward. So we'll touch on that in a bit. But before we do, another reminder before we get started, if you have any questions regarding any real estate or credit topics we cover today, just call the off-air line. It's 877-245-2030. That's 877-245-2030. And I will personally advise you in any way I can. Now we're going to jump into our Word on Wealth segment. This segment was brought to you by HomeGain. HomeGain is the place to get started buying or selling a home, finding a realtor, and getting real estate questions answered. So go to homegain.com today and see what I'm talking about. All you have to do is type in your home address, and you will get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. Check it out today, guys. Start your home search there. It's homegain.com. So this week's Word on Wealth, we're going to kind of jump in what happened from all the events of last week. So last Monday, the Dow was down. And it was kind of a volatile week, up and down, up and down. Interest rates went up, they went down, and then toward the end of the week ended up breaking about even. So they stayed about the same If I actually look, I was pulling up on, I believe it was Bankrate or CNN Money, the actual mortgage rate 30-year fixed as of right now is averaging 4.59% according to CNN Money. Last week it was 4.58, so just a tick up. Remember, these are rates that are quoted off of money.cnn. And when you're shopping for a mortgage, make sure that you are paying attention to APR, which is your annual percentage rate. It's the best way to, kind of gauge what kind of deal you're getting from one person to the next. If you're looking for a second opinion, feel free to reach out to me at 877-245-2030. I'd gladly point you in the right direction and see how I can best help you out. On Monday, also, the Empire State Manufacturing Report was below expectations. That's a survey of manufacturers in New York. It gives kind of a good feel about how the industries are doing. On Tuesday, housing starts and building permits came in below expectations. I touched that on a second ago. That's an indicator of the new home constructions and should they be building right now or not. On Wednesday, bond prices continue to stay at very high levels. This is causing incredibly low rates and great opportunities to refinance. And the Fed also released their minutes, which I had touched on earlier as well, where basically said they don't have any intentions of raising rates in the near term or even really in the long term. This is going to, by them doing that, and right now with all the other instability in the rest of the world, I would venture to say at some point you would start to see interest rates, they don't have anywhere to go but up. But like I said, I've been saying that for the last couple months, and it hasn't been happening. So as long as there is the instability in the rest of the world, I would say that we can probably keep these interest rates for quite some time. And as a matter of fact, I think that the Fed and the government will find a way to manipulate to make sure that these interest rates stay low, because I don't think that our economy can afford for mortgage interest rates to go up into that 5.5% to 6% range. I mean, I just think that would throw the country in a complete tailspin, into a depression. Would you agree with that, Lewis? What's your assessment of where we're at?
I think you're right, and we talked about this last week. They're damned if they do, damned if they don't, because long term, the longer you kick the can down the road, the worse it's going to be in the future. So you can take your medicine now and go through the deep recession, or you can just keep printing money to keep the interest rates low.
Which seems to be what they're probably going to continue to do.
Yeah, the political will is to really try to keep the low interest rate environment going. And that does, as you point out, create an opportunity, because interest rates should be higher, and they're not.
Yep.
And if you can take advantage of them now, you might as well, because eventually they have to go up.
Yes, that's, and I want to kind of touch on a story. This is one of actually a listener of the show actually had sent an email in and was kind of just, really just asking more technical questions about interest rates and what was going on with them. And I kind of, I said, well, look, we need to sit down and actually talk more about your individual situation, because everybody is different. And actually the real estate market's always good for somebody on a given day. You know what I mean? It doesn't necessarily, it's not going to fit for everyone. Interest rates could be at 10% and it's still a perfect day for a certain investor to buy a property. So everything is so specific to what you're looking to do short and long term that we needed to sit down and discuss what his options were. He was actually renting a townhome in Northern Virginia, and he was probably paying, I would say, about $1,650 to $1,700, and his lease was going to come due, I believe, the end of July. And we were going to look and see whether, it made sense for him to just buy or to continue renting. And we started plugging in the numbers. He said, he identified a price range that he wanted to stay within, and, basically said, I don't want to pay any more than what I'm paying in rent right now. And we started calculating everything. And last week when I ran the rates, they were somewhere, between 4.625 and 4.875, and plugged everything in. His mortgage payment with taxes, insurance, and everything were going to be somewhere around $1,575. So it made complete sense for him to move forward. He was looking to stay in the area for the next 10 years. He was a single guy, so it was perfect. He just knew he wanted another townhome, and he made it his own. He hasn't moved forward with the transaction, but at least he's armed with the information now where he can go out there and make a competitive bid. He can close in, 30 days or less, which is going to, get his offer looked at a lot quicker than some of the other offers that are put out there contingent upon another home that has to be sold. And, it was just a win-win situation for him all around. Plus, he's entering the market at such a low rate that when we do have this future inflation that's just inevitable, it's going to come. It's just a matter of when. He's going to be able to protect himself by locking in at that low interest rates. Now, I want to segue because there was another article online about, buying versus renting. And I thought it was interesting because, Lewis, you and I have been talking about this for probably the last month now. And just now it looks like they're trying to, go around the country and kind of check out different areas and whether it makes more sense to buy versus rent. And the headline was buy versus rent. These days, buying wins. So, and it seems to be like a cyclical thing because obviously, it's going to change over the 5 or 10 year period. But they showed, let me find the one. I believe it was, let's see, I want to say this is from rent.com.
They gave 10 cities.
Yeah, it was 10. It was 10 cities, but the one was interesting because I believe it was Maine or Boston. I mean, they said I believe it was Boston. They said the average rent for a decent size apartment in Boston was like $3,000 a month for something tiny. And that's one of those things where I guess it's like you're living closer to the city, so it's like the equivalent of living in downtown DC. So in some of those situations, I don't know necessarily space-wise whether it's going to make sense to rent versus buy because obviously you go to buy and you need a little bit more space. You're not going to really get near as much as you think you're going to get. It's going to be quite expensive. But in a lot of the major metropolitan areas right now where I think the rents are rising substantially, and rent.com was actually saying that they're expecting in the next 2 years for a 7% increase in basically rents. So it does make
an 8% decrease on the price of homes.
Yes, exactly. So in a lot of these key areas across the country, it does make a lot of sense right now to look into your individual situation and find out whether, you want to continue down that path of renting or jump into home ownership, which is basically super affordable right now. I've talked to, numerous people over the last probably 2 months, and I'd say probably 80% of them are good candidates to buy a home. I'd say of the other 20%, 10% don't plan on staying here, but for another couple years they plan on moving out of the area or just don't really know where they're going to go with the direction of their job. The other 10% had credit challenges, so we need to basically get them on the path, but they're probably 30 to 60, 90 days out. Now, we know that Zillow had reported that about 28% of all homeowners are underwater, or that's basically 1 in every 4 of you homeowners out there are underwater. In saying that, we're trying to provide people, real estate radio is all about providing solutions to you, the consumer. And the thing that I would urge first is if you're in that situation, if you're not able to maintain your mortgage, you're upside down, is to reach out to me because, I need to put you in contact with a professional that can first, try to see if we can modify your loan. Sometimes it's better that you have a professional try to modify it. Now, I know that about 90% of the modifications don't go through, so don't get me wrong. I'm not saying that this is definitely going to happen, but it's good you have to start somewhere, and you have to start somewhere way ahead of the curve before you start making late payments or before you make your bank account go dry trying to keep current on the mortgage. So reach out to us at 877-245-2030. That's 877-245-2030. We'll kind of run you through a little financial blueprint to try to get you in the right direction. We'll start with a loan modification. If that doesn't work out, we can put you in touch with a professional that handles short sales, that's done many of these. And don't let any realtor tell you that you have to be late on your mortgage before you can start that short sale, because I've worked with numerous real estate agents that have had success without having to have that person go late on your mortgage, which ultimately affects your credit. And then from there, we need to take it a step further, because if you are going to go down the short sale path, we need to make sure that we're going to set you up later to where you can buy again. So we want to, get you involved with a credit expert that can say, all right, we're going to set it up so you're not going to be late on your mortgage. We're going to try to process the short sale correctly. And then after it's done, we're going to get all your financials in line so you're able to buy again come that 2-year period that you have to wait. So reach out to us at 877-245-2030. It's 877-245-2030, and I gladly get you in touch with the person that can best help you. Coming up after the break, we're going to talk with Scott McDonald of RE/MAX Gateway. Foreclosures at the lowest level in 40 months. Stay right there.